Volume is a metric that is reported for all futures contracts. It is calculated by counting the number of contracts that have been bought and sold over a given time. You can track volume by using different time intervals, like daily or intraday. When a futures contract is traded, whether bought or sold, it counts towards volume for that contract. For example, a trader closes a short position in the ES contract by buying one ES contract in the same contract month, so ES volume for that contract month will increase by 1. Traders often use and interpret the rise or decline of volume in a futures contract to help make trading decisions. Volume can show important information to traders, such as it can indicate price levels where traders are more or less interested in trading a futures contract. During rollover, it can indicate to traders when to switch from trading the front month futures contract as volume decreases in the expiring contract. And it can also help identify the times of day that a futures contract is most liquid. When volume changes as the price of a futures contract moves towards certain levels, this can indicate to a trader that a change in direction may occur. Some traders may use this information to indicate whether to buy or sell at those key levels. During futures rollover, traders pay attention to the contract that is taking the higher level of volume. Traders use this information to determine when it is time to start trading the next month contract. As volume decreases in the expiring contract, traders will shift to a back-month contract. For example, the June E-mini S&P 500 contract is about to expire, and September is going to become the new front month. During the rollover week, watch how the June contract starts to lose volume, and volume increases in the September contract. If you are holding a June contract and do not want to hold it until expiration, you will want to pay attention to rolling of trading activity. Traders typically prefer higher volume times to trade, as it indicates there are more traders actively interested in buying and selling. When volume is high, the bid-ask spread is typically smaller. Orders are filled faster and there can be less gaps between ticks. For example, markets can have lower volume between the hours of 11 and 1 p.m. Central Time or right before major economic releases. Markets may have higher volumes around the open and close of the trading day or right after major economic releases. Traders can also look at average daily volume over a longer time period, such as a few weeks or months, to see if the markets are currently in a lower or higher volume than typical phase. What volume can't show is whether traders are buying or selling, or opening or closing a position. Let's assume the ES contract is trading at 23.75, and it suddenly pushes down to 23.60 while volume increases. What does this tell us? The volume that comes into the market could be from traders opening new long positions at key levels of support, which would indicate a bullish sentiment. Or volume could come from liquidation of exiting long positions or opening a new short position, which might indicate a possible bearish direction. Therefore, a spike in volume at 23.60 doesn't necessarily give us a good indication of where the market might be headed. Volume data is readily available for each futures contract and for the market as a whole. Even though traders may use volume in different ways to interpret how to trade, volume can be an important factor to help inform your trading decisions.